Welcome to the Prevail webinar series. This week we're looking at the alternative investment landscape. My name is Sarah Hilliard, and before we get started, I'm just going to give a little bit of an introduction on who Pascal is and the Prevail initiative that we've put together. Having a little trouble with my screen here. So a little bit about Pascal. So we are a technology company. We are headquartered here in Canada, in Toronto, and we provide wealth management technology services for portfolio managers, advisors, and we're sold to both portfolio managers and to dealers. And we believe in this decade, all successful investment advice will be digitally powered human advice. And we deliver this technology through a suite of different capabilities. And we believe that all of these modules provide something advisors want and need for their client partnership relationships. And this fully integrated technology platform provides that single integrated experience to address client management, client onboarding, portfolio management, custodial connectivity, and increased compliant insight. The beauty of it is that we are an API-driven platform, and we're very highly configurable so that we can fit into all sorts of industry ecosystems. And as mentioned, this is about the advisor-client partnership, and each one of these aspects of our technology is adding to this relationship, and it's showing that with technology, that true delivery of the device. So our advice, our Pascal team is a dedicated and experienced team of industry leaders. We're committed to driving innovation while understanding the nuances of what our complexity of our industry is. So we are a team of entrepreneurs, wealth management, operational experts, asset management pioneers, and behavioral finance leaders. So earlier this year, we had this full digital capabilities, but when the COVID pandemic crisis happened, we met as a team and looked around and wanted to actually help advisors during this time frame when we were shifting away from not able to meet face-to-face with the clients. And so we took a subset of our platform and we made it available for free with the help of some of the industry partners. So this is the best digital advisor client communication and engagement tools that's in the marketplace today. It's still available for free for a few more weeks. Starting July 1st, it will pivot to a subscription-based service. The Prevail platform has not only been about providing technology, but it's about providing a place for a conversation and discussion and re-examining investment strategies. So this has been a 12-part webinar series. And so we've had a mix of showing the technology, showing some practice management, the impact of the mental health, and how it's affected all of us and in our personal situations and how we continue to meet with clients, as well as these investment strategies. So we have had a number of them, and the good news is this week we made them all of the replays available online on our website, so you can just hit the Pascal Financial, Prevail, the webinars, and all the replays are posted there, as well as we've made a number of tutorials available through YouTube. So we have these links that you can quickly get an overview of our technology and how advisors are using that. So that's a background on our initiative. I'm now going to hand it over to Yves Revite, who will be introducing our guest speakers today.
Thanks very much, Sarah. Good afternoon, everybody. So aside from the Prevail being a technology platform that we're making it available to you to help you in your efforts to engage and communicate with your clients, we also decided as part of the initiative to essentially try to bring out some thought leadership in the context of obviously an investment environment that became very quickly very challenged and challenging. Things obviously have gotten a little bit better in recent week, courtesy of absolutely unprecedented measures that were implemented by the authorities, monetary authorities, fiscal actions, and so forth. That said, there remain significant challenges. The challenge related to portfolio construction remains largely unchanged, although arguably some of the diversification typically accessible through fixed income maybe hasn't been as great as one would like it to be. So today we decided that we'd take a look at the alt space, the alternative space, and obviously that's that one particular area that people look to when they're hoping to find things that are actually going to be working when everything else isn't working. So I don't want to put too much pressure on both of our speakers today, Bill Webb, partner at Waypoint, and Adam Butler, CIO at Resolve Asset Management. But the reality is one of their duties is to sort of figure out how to make things work when everything else is kind of not really working. So they're approaching the market in a different way than you and I might be if all we're doing is looking at the typical just sort of asset allocation kind of framework. They're looking at figuring out how do we put things together that provide a differentiated experience in relation to how the markets are otherwise behaving. How do we protect the downside? How do we look to reduce the overall correlation that some of their strategies might have to markets and so on? So I'm very pleased to welcome Bill as well as Adam this afternoon. I'm going to let each one of them give us some thoughts, share with us a little bit who they are, what they're about, what their firm is doing, and what their experience has been in maybe in recent months, given how interesting, and I use the word interesting in quotation marks, how interesting everything has been. And then we'll chat with them a little bit and try to ask questions that you may have, which incidentally you can feel free to use the platform to submit. And I'm sure that if I don't see them, Sarah or Hassani will see them and flag them. And hopefully by the time we are done, you've got a greater appreciation for the place that either Bill or Adam or both of their firms' respective strategies, the kind of place that these strategies could occupy in your client portfolios in order to ultimately and hopefully build better portfolios. So with that, I think first I'll turn it over to Bill, and then we'll pass it on maybe to Adam for a little bit. Bill, over to you. Welcome.
Great. Thank you very much, Yves, and good afternoon, everyone. So I'll just give you a very brief background of myself and our firm, and then get right into the challenges that we're trying to address, which I think are many of the same ones that face you and your clients. As you mentioned, I'm Bill Webb. I'm a partner at Waypoint Investment Partners. Professionally, I began my career in 1987 with Credit Suisse First Boston as a fixed income and then as a proprietary trader, trading across a variety of asset classes. I've also worked in China for the Bank Credit Analyst Research Group in the early 90s. And from 1995 to 2000 and the end of 2015, I was with Gluskin Sheff and Associates and worked my way from being an analyst to chief investment officer and one of the major shareholders of that firm. Retired at the end of 2015 to pursue some philanthropic pursuits. And over the next couple of years, as a couple of friends of mine became available, we created Waypoint Investment Partners as essentially sort of a multifamily office to co-invest initially in private markets, but also in public equity markets. And in late 2018, my former colleague at Gluskin Sheff, Ryan Marr, who is the portfolio manager of the all-weather strategy, had left Gluskin Sheff and became available and joined us. And at that time, we launched the all-weather strategy, which was initially offered in segregated accounts and via offering memorandum. It's now also offered as a liquid alternative mutual fund, liquid alt, that's available. And we introduced this strategy, which was an evolution of a strategy that Ryan had managed at Gluskin Sheff, but but had been discontinued at Gluskin Sheff late in his tenure. But we really liked the strategy and decided to implement it, and have offered it to our clients since then very successfully. And essentially, we do two things really well at Waypoint Investment Partners. The first one is we manage this all-weather strategy, which is essentially a volatility strategy composed of a high dividend yielding core portfolio of Canadian listed equities of about 20 different companies, non-resource companies for the most part, and that evolves from our experience at Gluskin Sheff, where we were very early investors in the income trust market, and many of those companies that eventually converted to becoming common equities. And that's a part of the Canadian landscape that if you look at these high dividend paying, many of them are mid-cap stocks with very clean balance sheets. If you just invested in that sector over the last 20 years, you would have done very, very well. And it's an area that we have great expertise in. And so we composed the all-weather strategy consists of a core long portfolio of high dividend yielding Canadian stocks, primarily mid-cap and non-resource, and we combine it with an options overlay. And during the more calmer markets and the bull market, where volatility has been very, very low, the ability to buy put options to hedge out your equity risk, both on the individual stocks or over the whole index, was very inexpensive. So it's not a market neutral strategy, but we're taking very little direct market risk, and we're always hedged. And so the portfolio has performed extremely well over time, both on an absolute and risk adjusted basis. Going back to what we're trying to do is, I think most of your clients and yourselves are trying to find, an investment portfolio that will deliver an attractive yield with relatively low drawdowns. I mean, avoiding our number one principle at Waypoint is to avoid drawdowns, is to avoid permanent impairment of capital. And that's where the option strategy becomes very effective. And we have on the portfolio an 8-year GIPS compliant audited track record. And the largest drawdown over that entire 7.5, 8 years is 3.8%. And that includes the most recent drawdown that we've had in the market and all the other ones that have taken place. So we've achieved that goal of minimizing drawdowns. The portfolio has compounded at over 10% annually over the years, and has had only one losing year where the strategy was down about 0.8%. But the most interesting feature of the strategy is that it has a very low correlation to the equity markets. It has a beta of just about 0.15 and a very low correlation to many other asset classes. And I think that in the current market environment, what people are looking for is assets that are truly diversified. We saw in the most recent drawdown in the market how everything began to correlate to one, including briefly corporate bonds, but also even treasury bonds when we were in that liquidation phase. So it's important to have a mix of assets in your portfolio that will provide you with that, relatively low drawdowns for the overall portfolio. So the second thing that we do, in addition to managing the all-weather strategy, is to help people with asset allocation. And so we have proprietary asset allocation software that we've developed over a number of years. And what we do is work with our clients, whether those are, and our clients are typically through the IA channel. Increasingly, we are on the platforms of all the major banks, with the exception of TD, which we're working on, and we're also on the platforms of Echelon Financial Partners, Canaccord Genuity, and Wellington Altus, and as I said, all the other major banks. So what we do is work with investment advisors and their clients to help design optimal asset mixes and to achieve their objectives. It's not a black box, and it's an iterative process that we can work with people to help them construct an asset mix of equity strategies, fixed income strategies, other assets, whether it's real estate or other alternative strategies, and work within the constraints and the objectives that they set. And we work with folks to construct those asset mixes. And invariably, what we find is, because the all-weather strategies had a very low correlation with the overall equity market, and strong performance both in absolute and relative terms, it acts as a very good stabilizing force that adds to the Sharpe ratio, that measure of risk-adjusted returns within a portfolio. We offer that service. That asset mix service is something that we provide free to IAs or families or foundations or pension plans that we work with. We also do consulting projects if somebody wants a one-off project done for them, and it's fairly flexible in the asset classes that we can look at. We built up quite a library of different asset classes and different strategies. And again, it's very customizable in working with our clients. So I think I'll pause there. I know there's going to be time for lots of questions, but that gives you an overview of the strategy that we're running, and look forward to the conversation and to the questions.
Thanks very much, Bill. That was great. I know from having known Adam for quite some time that he actually doesn't do at all what you're doing, Bill. So in that sense, there is no overlap. Adam, if you're now able to articulate for us exactly how Resolve approaches that big challenge of figuring out how to diversify, how to deal with drawdown risk and all of these sort of things, I'll turn it over to you, and welcome.
Thank you. Yeah, great to be here. Thanks for having me. Yeah, so by way of introduction, I am the Chief Investment Officer at Resolve Asset Management. We're Toronto-based. We have operations both on the wealth and asset management side in both the US and Canada. We focus on high capacity, quantitatively oriented global asset allocation strategies, with the objective of being resilient to all of the major economic regimes that we define as surprises along the dimensions of economic growth and inflation. We manage ETFs and mutual funds in both the US and Canada, as well as separately managed accounts, and run the mandates with, we have futures mandates in both the US and Canada, and we also run with ETFs. So a wide variety of different channels, but the overall focus is on the asset allocation problem. And the reason we focus on asset allocation because that is the only domain in which it is possible to deliver strong results with confidence over any of the major economic environments that we might be able to envision. So for example, if we take a simple framework of dividing the world's economic regimes, like I said, by inflation and growth, so you have periods of high inflation and high growth, low inflation and high growth, high inflation and low growth, low inflation and low growth. There are markets that are fundamentally designed to do very well in each of those environments. They are different markets. And so, you know, we think about how do we maximize diversification being a combination of two things. One is diversity, and diversity is about having the access to markets that are able to thrive in each of these different economic regimes, and then balance. So we all know that treasury bonds and crude oil have very different ambient risk profiles. So if you put 50% crude oil and 50% 10-year treasury bonds in a portfolio, the portfolio is going to be completely dominated by the risk of the treasury bonds. So you can imagine expanding your investment universe to all of these different investments in different regions and different currencies and different types of asset classes. They have different ambient risk levels. So there needs to be a process for ensuring that they are all able to expose or express their unique personalities in the portfolio in order to maximize the diversification of the portfolio. So that's sort of the broad framework. And then we also think a lot about how to expand the idea of diversification outside of the sort of market space. So thinking about stocks and bonds and commodities, for example, and then into the factor space. So a lot of people think about value factor allocating stocks with high book to market ratios and shorting low book to market ratios, or momentum stocks, that sort of thing. So that is a way to think about factors, but we think about it in the multi-asset space. So in the multi-asset space, markets trend, markets with high carry tend to go on and outperform. Markets with low carry or negative carry go on to underperform, et cetera. So there are these same types of anomalies or risk premia in the multi-asset space that are generally uncorrelated to the overall markets. And so to the extent that you can expand your concept of diversification into as many different independent bets, if you will, then that is the surest way to build a portfolio with confidence that can thrive through all of the major different types of economic regimes. So that's kind of how Resolve approaches the problem.
Okay, that's great. Thanks very much. So that sort of sets the stage for a little bit of a discussion now with the both of you guys. And I guess what I would ask is, every advisor that is on today, and I'm sure all of us in the financial industry, obviously, from the middle of February onward, things changed rather dramatically. So I'm wondering if each one of you can actually share with us a little bit what you experienced from that sort of mid-February to, let's say, March 23rd lows, and since then, in terms of the kind of signals you've been getting, respectively, the kind of action or changes that you've seen fit or that your strategies have had you look at considering and implementing, and give us some thoughts around that and how you see yourself positioned for what kind of a future going forward. We all know that there's a whole alphabet soup of how people think we're coming out of this pandemic, if in fact we are. But I'm hoping you can kind of both share your thoughts and experience through what we've gone through in the recent past. So Bill, if you care to kick off.
Sure. Well, it's been quite a ride this year. And just to give some context, if we go back to 2019, for Waypoint, our strategy that year, the markets were up quite strongly in 2019. We were essentially flat, down a little bit, because markets were trending higher, and the put options that we had on, basically as an insurance policy that we were paying away to protect the downside, as we always are. Again, we're not making big directional or making directional bets on the market. What we're trying to benefit is from, number one, our skill as fundamental analysts and stock pickers in a very well-defined market, in a very well-defined universe of companies. And then we are, secondly, assessing when volatility is cheap or expensive and monitoring that very, very carefully, and how we can best express that through the options market to preserve capital. So the world changed very quickly as we came into 2019, when the markets collapsed. The put options that we had on that had been a drag in 2018 suddenly became very, very valuable and drove a strong return and protected us from any downside in the market. So, calendar year to date, the strategy to the end of May, the strategy is up about 8.5%. And we did not have a drawdown. In the months of February, March, and April, the portfolio was up a few percent each month. The month of May, as the markets rebounded, we were down very, very slightly. The adjustment that we made is when the market collapsed and volatility became very, very expensive. And if you looked at the VIX going to almost 80 and the put options that we had on becoming very expensive, what we did was we sold the put options, a number of the put options, and in the interest, because we're not taking a market bet, we also liquidated some of a good portion of the equities that we owned in the portfolio. So we were triggering capital gains on the put options that had made a lot of money. We were triggering some capital losses to offset. So there's great tax efficiency in this strategy because of the way that we manage it. We then had a great deal of cash in the portfolio. We had preserved capital entirely and actually made money during the drawdown. Now we were faced with a very different situation towards the end of March. Volatility had become very expensive, and in particular, what had become very high was skew, the difference in value of put options versus call options. And so what we began to do was implement what we call risk reversal trades, where, just to give an example, we could buy a particular equity, sell a put option, let's say 20% out of the market below the current price of that equity or that index, collect that premium and thus be protected for 20% downside, and buy call options, let's just say 20% above the market. And because the skew was so high, we were able to buy 1.5 to 2 times the amount of that exposure on the upside. So we would benefit. We'd have a significant amount of downside protection given where the puts were sold, and we had and we had that premium, that buffer, and we had exposure to the upside in the event that the market was to grind higher. And so that has worked, that has worked quite well on the upside, and that's how we apply. We're constantly assessing whether we think volatility, and we have some proprietary tracking mechanisms that we use to assess whether we think volatility and the options, related options, are expensive or cheap, and then we express our risk management accordingly. And of course, when that happened as well, when the market collapsed, there were also a number of companies that had been on our radar screen that we wanted to own for a number of years that had maybe been too expensive because valuations were, quite high, obviously going towards the end of 2019, early 2020. At least, and looking at that, I say that in a bottom-up context, as we know these companies very well and track their valuations and our models and estimates of their intrinsic value. In that context, there became available a number of companies that we hadn't been able to buy for years at attractive valuations. And so we did take advantage of that and continue to do so, because obviously on the recovery, certain portions of the market have done better than others, and some have lagged. And just to reiterate, we invest primarily or exclusively in non-resource companies. So we're not active in the energy sector or the mining sector or forestry products, just so that folks know. So that's how we've dealt with what's been a very exciting year so far.
Thank you. Adam?
Yeah, so I think I'm going to zoom right out and talk about some of the ways that you might evaluate the markets this year, and how strategies have responded and how we should think about those responses, because it's been a really good case study of the idea of diversification. So we come into 2019 was obviously a period of very low volatility, declining inflation risk. So sort of inflation continued to sort of surprise to the downside. Growth continued to be weak, but came in ahead of expectations. There was abundant liquidity in the market. The Fed had backed away from their tightening stance, which they had begun to make noises about in late 2017, 2018. And this environment of benign inflation, better than expected growth, and abundant liquidity is extremely favorable for equities. And so we saw this steady climb with equities on very low volatility, as Bill alluded to. And this environment sort of peaked in late February as this benign environment of reasonable growth began to grind up against the reality of this oncoming virus freight train. And in late February, the market, on a dime, shifted into a completely new regime. And it was astonishing how quickly this happened. Just for some context, we went back to 1900 and examined the current crash in the context of other major crashes in US equities. And the February-March crash happened twice as fast as the 1987 crash. And in terms of like the time it took to go to a certain level of drawdown, and over 3 times as fast as the 1929 Black Monday crash. So this was an unprecedented crash in both the magnitude and the time it took to get to that magnitude. So obviously, it wasn't something that you could, it was a difficult thing to tactically shift out of using typical discretionary tools and even most tactical quantitative tools. So what did work? It's interesting because you remember I framed the idea of how we think about building portfolios in the context of how they respond to inflation and growth. And so as an example, stocks, like I said, do very well with benign inflation, reasonable growth, and abundant liquidity. What does well with the threat of disinflation, a negative growth shock, and a contraction in liquidity? Well, treasury bonds do very, very well, right? So for example, a portfolio that was well balanced between stocks and treasury bonds coming into February and March would have whistled past the graveyard. And in fact, if you look at some of the major global risk parity funds, the professionally managed global risk parity funds, they're basically flat on the year. They did have a 1 week dip in late March when the other major risk reared its ugly head, this liquidity risk, where I think Bill mentioned that not even treasuries had a bid. Like there was gap risk in the treasury order book, which is truly unprecedented. We didn't even see that in 2008. So, you have major gap risk in every major market category. The Fed eventually stepped in and said they're going to put a bid on credit, put a bid on treasury bond ETFs, et cetera. And that eventually closed those gaps, and we normalized. But with the exception of that sort of 1 week major drop that then corrected the very next week, these risk parity funds, which maximize diversification, did very, very well. Now, there was one complicating factor, and that is that it's well and fine to say that you want to have a maximally diversified portfolio that's resilient to any major economic regime. Often that means that you've got a lot of bonds in the portfolio in order to provide ballast to the fact that stocks and commodities have much higher volatility than bonds. And a portfolio that's got a high allocation of bonds, while it is a very efficient portfolio, has a high expected Sharpe ratio, it probably doesn't have a very high absolute return. And so going back to the theories that were proposed by Traynor and Sharpe and Markowitz back in the 60s, what do you do when you've got a very efficient portfolio that's got a low return? Well, you need to lever that portfolio in order to hit your target return. So risk parity portfolios that are maximizing diversification, but that are trying to hit a certain target return, they're using leverage. They're using leverage then by targeting a certain level of volatility. For example, if you've got an expected Sharpe ratio of 1, just to keep the math simple, and you want to target a 10% real return, then you might want to scale it to a 10% volatility in order to get your 10% expected return. And that might require 2 or 3 times leverage in the portfolio. And you're relying on that volatility in order to determine how much leverage you need. So what also happened in February was that there was a massive expansion of volatility. And so a lot of strategies that were well diversified ended up having too much risk on, and it was just sort of like catching up to this expansion of volatility. And so depending on your required return and the amount of leverage you had in the portfolio, that also impacted the results. Then a third thing is, of course, it's one thing I want to target maximizing my diversification, resiliency to any economic regime. I want to hit my required return. Are there any active edges, factors, or active strategies that you can layer on in order to also improve those returns? And I think that there's a mixed bag on how those performed in this crisis. So if you look at strategies like short-term trend actually had a nice little upswing during the major downswing in March. Longer-term trend strategies were down. Carry did well. Some of these other strategies like seasonality did very poorly. There's a seasonality ETF in Canada, for example, that's done very well for many years. That had a very bad time because it wasn't typically a period where risk-on markets or equity markets are usually vulnerable to this type of risk-off environment. So, leaning into that factor was a complication. So, there's a number of different lenses through which to view the recent period. I'd say diversification done properly continued to work very, very well. And it was a great case study, and it passed that test very well. But there were other dimensions of this environment that were challenging and made it more complicated in terms of both how to navigate it and how to position for other types of environments like this in the future. You're on mute, Yves.
Sorry about that. Thank you. Appreciate it. I think that captures it fairly well. I would say going forward, What's the main challenge? I think we've got a couple of different sort of elephant in the room, and I'm kind of wondering what you guys see as them potentially being as they relate to a traditional advisor book of business, if you will, and respectively, how is some of what you're doing relevant, not because of how well you did or didn't do in March and April, but more so in the context of some of these elephants and the longer term implications of them and the kind of risk environment that we find ourselves in as a result of, yet again, unprecedented interaction or actions on the part of the Federal Reserves and the monetary authorities, generally speaking.
Should we continue with our previous order?
Yeah,
Bill,
sure.
you wanna go with that one first?
Yeah, I think that the basic challenges of, the priorities haven't changed, but the challenges are escalating. And I think, again, what we come back to at Waypoint is, number one, don't lose money. Two, compound it in a responsible and appropriate way. And our view is we had for a decade unprecedented intervention in the financial markets, quantitative easing. We've had low tax regimes. We've had all sorts of things that have boded very well for risk assets. The system, I think, became wound. I like to say it got wound very tightly. Valuations were relatively high. Volatility was low. Interest rates were very low. Credit spreads were very low. There wasn't, profit margins and returns on equity, broadly speaking, were quite high. So you had you have a system that's wound very tightly and leaves you little room for error. And then we have something randomly come across like the coronavirus, which nobody predicted. We certainly weren't expecting it, and it didn't change how we were positioned. It hadn't changed. It happened. We were protected and prepared. Had to adjust after it happened. But I think now we're seeing. So that's been the situation. We've had a major disruption here in the financial market, which has recovered considerably, and a major disruption and dislocation in the real economy, which has yet to play out to see what that recovery looks like over time. And we are now seeing, financial intervention of an even greater scale than we've ever seen before, with the authorities saying that, there's really no limit to it. So our expectation is that, you will see more increased volatility will become a feature of these markets going forward. We had a decade of very, very calm financial markets. We think that is less likely going forward, given the setup and given where valuations are, where interest rates are. Spreads have widened out, but have come in on corporate spreads given the intervention. But and tax rates are already very, very low for corporations, broadly speaking. So one has to expect a more volatile environment going forward. Therefore, what Adam and I are talking about here today is making sure that you have a properly diversified and well-diversified portfolio is going to become more essential. And therefore, you need two things. You need to be able to identify some of those asset classes or strategies that are not correlated. And two, you need to have a process and some technology to be able to actually prescribe that portfolio and look at some different scenarios and make sure that you're adequately diversified. So it's become really the whole topic of this conversation. This is the core essence and the most challenging feature that faces everyone. And therefore, it's the whole topic of this talk, the alternative landscape. I think in that framework, alternative asset classes and just being able to provide your clients with access to more different asset classes has become even more important than ever. And I would say, based on the feedback that we've had, and I think many of other people in the industry, people are, the phones after a period of shock in the month of March and April, people are sort of coming up for air. Thankfully, we've had some recovery in many risk assets. Now is a great time to be able to evaluate and think about, how would I change my asset mix so that the next time it will be a different event. It's always different when the next time the next event comes around. How can I fare better and how provide less volatility for my clients? So, and that's what we're here to help with. And one of the things, I think one of the practical things that we do with people, to just speak very practically, is IAs or foundations will come to us with groups of asset classes or strategies that they're very comfortable with, where they've done, they've done a lot of research, or they've held them on behalf of their clients for many years. They've done a lot of due diligence, and they know the managers and the strategies. Actually being able to optimize those correctly within that client's particular objectives and risk tolerances and constraints is something that we like to help them with, and where we think we can add value. Because often you may have a great set of strategies, but if you don't have them allocated appropriately for what it is you're trying to accomplish, then you've left money on the table and you've increased risk, to put it simply.
Thanks, Bill. Adam?
Yeah, I mean, I always go back to the late great Peter Bernstein, who said that diversification is protection against ignorance. And I think if this market environment over the last few months hasn't awakened investors to the fact that nobody knows anything and nobody can predict the future, then they can't be helped. I think it's, the sad thing about diversification is that it means always having to say you're sorry, right? Because there's always going to be something in the portfolio that is lagging. And if you're doing it right, there's always something in the portfolio that's lagging a lot. For example, commodities are an asset class that have just been obliterated over the last 10 years. On a relative return basis, over the last 10 years, commodities have the worst return relative to global equities that they have ever had. And so if you, in acknowledgement of the fact that commodities are the only asset class besides tips that are fundamentally designed to hedge against an inflationary environment, if you've been hanging on to commodities or commodity related exposure like commodity stocks, for example, over the last 10 years, your clients hate those positions. I'm sure that you have gotten calls every year, every time you sit down with clients. If you've got direct exposure to commodities, they've been asking, when can we get off this position? Why is it on the books? And it's just been an excruciating time because the simplest conceivable asset allocation, the Vanguard asset allocation of primarily US oriented 60/40 has had its best decade ever. And so as investors look back over the last 10 years and say, how should I invest? Any empirical case study that you can bring to bear that prioritizes diversification is going to look worse than their dumb 60/40 portfolio. And so it just makes it almost impossible to argue or advocate on behalf of diversification, even though, if we even expand the telescope back beyond the past 10 years, the period from 2000 to 2008, US equities had zero return. And over the last 20 years, gold has outperformed US equities. Treasuries have outperformed US equities over the last 30 years, but investors' time horizons are so short. So it's always this constant battle between the fear of missing out. It's this cocktail party risk, or what somebody calls Thanksgiving risk. You've got to go and talk to your parents and your peers, and you've got to make sure that you've got something to talk about that allows you to keep up with the Joneses. Meanwhile, you're trying to do the right thing to hedge against all the possible risks that you as advisors, as people who are educated about the historical risks in markets, know are out there and may leap up at any moment to bite these clients and leave them vulnerable against their financial objectives. And so, we are constantly of the view that most investors are massively over-positioned in equities. For Canadian investors, they're massively over-positioned in Canadian equities. I remember a year or two ago chatting with the head of asset allocation for one of the major Canadian firms. I asked him to go through his book and let me know what position of total portfolio capital exposure was Canadian across stocks and bonds? And the answer was 87%. 87% in Canadian stocks and bonds. Meanwhile, Canadian stocks and bonds represent less than 3% of total global market capitalization. This is an atrocity. And the question is, how do you persuade clients to diversify away from this, to take advantage of global diversities in the evolution of different global economic regions, the diversity from different global asset classes, in recognition of the fact that 60/40 portfolios can go through 10 or 15-year periods of negative returns. That's happened, if you go back to 1900, that has happened on and off about every 15 to 20 years. You've got this period of massive returns for US for 60/40 in general, and then a flat period that lasts for 15 to 20 years. And so obviously we've gone through a period that was very friendly to 60/40. We have no idea if the next 10 years are going to be nearly as friendly to 60/40. And the question is, how prepared are most client portfolios for a change in economic regime? And my strong assertion is that they're completely unprepared. They are positioned for continued strong economic growth, continued benign inflation, and abundant liquidity. And that's fine, but if we don't see that, then all of these clients are going to be unable to achieve their financial objectives. And you know who's responsible? We are.
That said, Adam, Hassani here, you guys have been doing amazing. I just wanted to actually ask you a quick question, and then also Bill, in regards to how we're seeing a possible retrenchment in globalization. How does that work for your portfolios? Is that a benefit or not so much? Again, all correlation for most asset classes have been going towards one. So now that we see a movement back away from globalization, is that a good thing for you guys and for the markets that you purvey?
I think that was directed to Adam.
Yes, it was.
Sorry. Yeah. Well, I mean, globalization, which has been a force, it's been the dominant economic force over the last 30 years, was profoundly disinflationary. We had disinflation in the cost of labor and disinflation in the cost of goods, right? As we're able to source more goods from the economies in the emerging world. And as the manufacturing base in the developed world, which is very expensive relative to the manufacturing base in the developed world, the cost of labor then did not keep up with inflation, right? If you look at the wages, for example, for all but the top 10% of the income distribution, then those wages have been stagnant in the developed world for 30 years. And globalization is a primary culprit for that dynamic, because a lot of those sort of middle class manufacturing type jobs have been offshored because there are people offshore that are willing to do those jobs much cheaper. And so if that trend reverses, it's hard to see how that will not lead to a shift in the inflation-deflation dynamics from a primarily disinflationary regime to an inflationary regime. Now, if there's no way to know in advance whether the deflationary forces of, for example, an overwhelming amount of global debt are sufficient to outweigh some of the macroeconomic forces related to domestication of the manufacturing base or core functions of the economy, like important services or emergency services, that sort of thing. It's impossible, I think, to know in advance, but I think we can say that there are now forces building that provide a higher probability of needing to be concerned about inflation over the next 5 or 10 years than there were in the previous 30 years. And again, begging the question, are investor portfolios sufficiently prepared for that type of shift? And I think the overwhelming answer is no.
Okay. so we could look to you to help us to put on those wheels. And I guess this question to you now, Bill, in regards to the mid-cap Canadian space that you purvey in, with companies that aren't paying dividends but are making amazing progress in Canada, such as the technological resurgence of companies like Slack, like Shopify. How do those play in your portfolio, if they do at all? And what's your view in terms of dislocation that we're seeing in terms of entrepreneurship in Canada? What can the government do to help to get companies up from small into mid-cap territory? So basically the disconnect between Main Street and Bay Street. How do Main Street small, medium companies come up into your screening?
Sure. Well, to answer specifically with regard, I mean, about 95% of the companies that we invest in have a dividend, and a very attractive dividend. In those exceptions that don't have a dividend, they are companies where the cash flow, the free cash flow generation is very high, and where we believe that the probability of them implementing a dividend is very high, that they will implement one. So that is an important screening criteria. And just, I don't, public policy, I don't want to get too carried away with it. I think the government should always be doing, taking measures to promote entrepreneurship and the growth of small and medium-sized businesses. We're dealing in the public equity market, and there is a shortage of public companies. That's the bigger challenge, is that more and more companies are deciding not to go public. But from a practical standpoint, as an investor, our screening criteria are very, very strict. The universe of companies that we're not looking at, we're not trying to make valuation calls on indexes. We really are fundamental business analysts focused on a very small universe of companies that have to do three things. They have to pay a dividend or be about to pay one. They have to have very high insider ownership. And we measure that as, where management is aligned with us and relying on that dividend. And three, they're non-resource companies. So regardless of any other sector any sector that a company may compete in, if it can meet those three criteria, we'll take a look at it. And that universe is actually very small. It's just over about 100 companies of Canadian listed companies. And our goal is looking at that list and trying to find the 20 to 25 best companies where our estimate of the intrinsic value and that risk reward ratio and fundamental valuation is attractive to us. So that's where we focus. Love it if Shopify were paying a dividend and had a valuation that we could come to terms with. It could be a candidate, but it's not currently in the portfolio. But we are, even without those very narrow and strict criteria, what we're really trying to find is excellent companies with excellent management teams that are aligned with us. That's good because it focuses your work, and it actually has generated a portfolio over time that is better diversified than the S&P TSX index, which is, has a very strong weighting in resources and in, very large cap financials, where it's hard to act, where, fundamentally resource companies are not traditionally good businesses. If you just look at historical returns on capital, very, very few of them earn their cost of capital. So we choose not to invest there, and very few of them pay reliable dividends. And on very, very large cap companies, they tend to be extremely well covered by the sell side, and it's hard to find we are big believers in active management, and many of the companies that we invest in have very little, or in some cases no, sell side coverage, and therefore we can get a real active management advantage and then use the options market to manage the risk around that.
Thanks,
Splendid.
Bill.
Thank you.
Hassani, sorry, I'll take over briefly here. Unfortunately, our time together is coming closer to an end, but I want to address one final question to the both of you, and that is, how much of a slice of a portfolio do you each think that your respective strategy can or should occupy, and respectively, how do advisor figure that one out, if you will, if you were to advise them, Bill, given how you're looking at, making people recommendation on asset allocation, how do you help them with that particular challenge of figuring out what's the right exposure to the alternative space, whether it's your strategy, Adam's strategy, or somebody else's strategy who also happens to provide uncorrelated return with downside protection?
Yeah, there's no simple, cookie cutter answer. It's really a process. And so that's how we do it. We have people who, clients who have 3% exposure, and we have clients who have 50% exposure. It's really all about what are their particular objectives and risk tolerances. What are their constraints? How many strategies are they comfortable having in the portfolio? So we just work with people in a very transparent process to come to that answer together. That's how we do it.
Okay, Adam?
Yeah, I mean, I hate to keep banging the same drum, but really it's let's start with the basics and create a properly diversified portfolio from first principles before we even begin to look at alternatives, right? At the moment, you've got these antiquated 60-40 portfolios, which happen to have worked out ex post, but where we know that the distribution of potential outcomes doesn't in any way always favor that type of outcome for that portfolio. And so let's start with better diversification. Let's get a higher allocation to risk off type markets. Let's right size those in the portfolio. Let's get an allocation to markets that are fundamentally designed to do well in an inflationary environment, like diversified commodities, gold, and tips. And then once you've got appropriate diversification in the sort of fundamental landscape of asset allocation, then maybe you can think about, are there proven, theoretically robust alternative risk premia that are also likely to continue to deliver strong performance, whether that's an allocation to a value tilt or to a momentum tilt, or an allocation to trend or to carry strategies, or what have you. There's all of these other strategies that have very long evidence behind them, and like abundant evidence behind them, and that have played out in live trading that I think are worth consideration. And then if you also have access to managers with demonstrable discretionary skill, in my opinion, those managers tend to be managing highly capacity constrained strategies in very narrow segments of the market, where they have a very strong set of experiences or skill sets that give them a unique edge in that very narrow space. Then those are terrific add-ons to a portfolio. In my experience, those are very rare. And if you can get access to those strategies before they get so big that they can no longer really pay off in the way that they were originally designed to pay off, then that's really phenomenal. But by virtue of the fact that they are constrained capacity, they can't be 50% of everyone's portfolio, right? I mean, the strategies that we design encompass 90% of global market cap. I'm talking over $100 trillion in global market cap. So whatever we allocate to them is a mosquito on an elephant's arse in terms of the impact that it has on the total markets, and our capacity to run the strategies are almost infinite, right? So let's start at high capacity. Let's get the basic asset allocation question right. Let's start with diversification and balance, and then start to get fancy. But to my observation, most clients and most advisors at the moment are very far from having a robust, diversified core portfolio. So, starting to think about alternatives puts the cart before the horse.
Yep, definitely sounds logical to me. Sarah, I think I'm going to turn it back to you at this point. Thank you very much, Bill and Adam, for sharing your thoughts and insights. I'm sure we'll have ample opportunity to keep interacting going forward. And of course, in terms of the advisors that are on, if you have any questions and issues that we haven't necessarily addressed or touched on, we're happy to try to get hold of Bill and Adam and ask any kind of follow-up questions and address these and get back to you. So with that, Sarah, back to you.
All right, so thank you, Adam. Thank you, Bill. Thank you, Eve, and even Hassani for jumping into this discussion today. And just as a look forward, so next week we have another interesting topic in the investment landscape where we're taking a look at the financial sector, both domestically and globally, and seeing how they fared before and after the COVID and what the outlook is. So we're having the Hamilton ETFs and Rob Wessel in particular that will join us for this fireside chat. We are also, in the last week, we listed a raise on Deal Square. So we just wanted to put a reminder out about that. So we do have a private placement. We have also had a live demo of the full platform that we did with Josh Schmidt yesterday, which is available for replay for those that are interested. And Hassani, if you'd like to close for us, please.
Thank you, Sarah. Yes, as always, we encourage advisors to continue to evangelize in terms of the disruption that we here at Pascal are bringing to the marketplace. Again, bringing digital disruption with fully AI-powered behavioral finance-backed platform here in Canada with arguably the best client management and engagement tools, thanks to our amazing CTO, Tail and Pins, which are very modular and API driven. And in regards to the Prevail initiative, helping advisors and their clients continue to prevail during this COVID pandemic. We love to thank our partners, Starlight Capital, Fidelity Custody and Clearing, Morningstar, and also our charity of choice, the Canadian Mental Health Association. And we thank again our guests today, Adam Butler and Bill Webb. And please reach out to myself and or Sarah with any questions or concerns and webinar requests. Thank you so much, and stay safe, everybody.